Do you want to take the sting out of your portfolio when the market's down? There are 5 strategies I love to deploy when the portfolio and the market is going through some volatility. Now, the first strategy really isn't a strategy as much as it is just avoiding that big mistake. We talked about this in the last episode. It's avoiding that emotional reaction. One of the worst financial moves that you can make when the market is down is selling out of your positions while they're down. You want to go back to that old adage of buy low and sell high. When you get nervous when the market's down and you end up selling lower, it goes against the very foundation of investing. And that's why it's really important to have that expert, unbiased opinion in the room with you when you're looking at your portfolio. This is a mistake that I see a lot of DIY investors make, and it's something that can really cost you in the long run. So the first one is just avoiding that emotional reaction. The second strategy, now that we're starting to get into the actual strategies of things that we can do, the second strategy is tax loss harvesting. What I love to do when the portfolio or the market is down is look through my entire list of holdings and try and see, okay, is there anything that is now at a loss? If it's a non-qualified account, I want to go in there and I want to sell that position and I want to replace it with a very similar position. This way, I'm not missing out on any potential recovery time. But by selling that position at a loss, I have now locked in a big taxable benefit. So that's a really great way to help your tax situation when the market's down and your portfolio is down. The third one is buying in lower. And for this, I like to compare the market to a coupon. For me, my wife and I do a lot of our grocery shopping at Meijer. If Meijer were to ever send me a 30% off coupon, sometimes the market does that when it's down 30%, view it as a coupon. If Meijer were to send me a 30% off coupon, you better believe I am not just doing that week's worth of grocery shopping. I'm planning to stock the shelves and I'm planning to make sure we've got a lot of things to eat for further on down the road. It's the same exact philosophy when the market hands you a coupon. If the market's down 30%, most people are getting incredibly nervous. I want them to view that as an opportunity. If you have any cash on the sidelines, if you have some fixed income that's not designed for the next couple of years of distributions, those are great assets to look at and say, hey, how can I be utilizing those funds better? Fourth strategy is resetting your capital gains. And this strategy works beautifully if you're in that 0% long-term capital gain tax bracket. Now, I could spend an entire episode breaking down this strategy entirely, but I mainly want you to know that long-term capital gains is not always taxed at 15%. A lot of people think that it is. If you make under a certain amount of taxable income, it's actually taxed at 0%. So if you have a non-qualified account, if the market's down, I want your advisor to be thinking about these types of things. They should be bringing these opportunities to the table for you. The fifth strategy is Roth conversions. Now, I know we've spent a lot of time in previous episodes talking about Roth conversions, but maybe what we haven't quite talked about is the best timing for it. The reason that I love market volatility and your portfolio being down to do a Roth conversion is because we're repositioning that Roth conversion amount fully for recovery, meaning that recovery is going to take place in our Roth IRA, growing tax-free, instead of in our traditional IRA, growing tax-deferred. Remember, the Roth conversion strategy is about moving assets from that tax-deferred bucket over to a tax-free bucket. So when the market's down, a Roth conversion strategy is a beautiful time to deploy it. So when you think about market volatility, when your portfolio is down, the human reaction is to get nervous. What I want to do is change that reaction to one of opportunity and optimism, because there's almost always something that you can do inside of your portfolio to take advantage of it being down. Remember, when the market is down, think of it like a coupon. There's always something that you can be buying at a discount. There's always some type of tax strategy that we can be deploying. And the reason we can think about it that way is because we know that volatility is normal. We know that it's to be expected. Again, go back to the last episode where I talked about the 3 types of volatility. It happens on a pretty regular basis. No, it's not locked in on a set schedule, but we know over a 20-year period, yeah, we're probably going to have 3 to 4 different bear markets throughout that period of time. Knowing the volatility, knowing the types, And then also knowing some good strategies to deploy are a great way of making sure your portfolio stays ahead as well as aligned to what your objectives are. Again, these are strategies that are a beautiful thing for your advisor to bring to the table for you. If you've gone through batches of volatility in the past and maybe you didn't hear from your advisor, that could be one of those signs it's possibly time to look for a new one. If you've enjoyed this episode, go ahead and hit subscribe, and we'll see you on the next one.